Welcome to Sand Compounding. This is Sandeep Anand. Accounting is the language of business, and one needs to understand as an investor to learn accounting and understand how to read balance sheet. It's a very important skill, but many of the times it is misunderstood that investing is all about financials, and it's a very wrongly misconstrued understanding. And accounting only forms in such a way that you need to understand how the business is functioning and appreciate the numbers there. That's all the limit is to the accounting. Now there are two derivative documents which drives the accounting, and those are the annual reports, which are a comprehensive and exhaustive view of every part of the business operations, and companies report this annual reports once a year, as the name says. And in addition, there are quarterly reports which are stipulated times of every quarter these reports come out, and within these are subsumed the balance sheet, which gives a complete understanding of the health check, financial health check of a firm or a company. Now a balance sheet has two parts to it, and I'm going to explain every part of the balance sheet, how to analyze the three components, that's asset side, the liabilities, and the equity. We have divided this session into two parts, one part to dedicated for understanding the long-term and short-term assets, and the other part to understand the long-term short-term liabilities along with the equity side. Let's get into the details. So let's take a real scenario of annual report from Walmart's 2017 annual report. Let's take the balance sheet in that and go through every part of that balance sheet. So the fundamental concept in any balance sheet which is taught in the MBA schools and others is like it should balance, right? As the name states, the total assets should be equal to the liabilities and equity put together. So let's first go through the assets section of the balance sheet, and then through the liabilities, and finally the equity section. So this whole section is divided into two parts. First part of next 30 to 45 minutes we'll go through the asset side of the balance sheet, and then in the second part where we will go through the liabilities and equity put together. So here is a view of Walmart's balance sheet. Typically the assets are shown on the left side and liabilities and equities is shown on the right side. Now typically every company shows to their latest 2 years of data from accounting standpoint. So here it's 2017 balance sheet, so that pertains to 2017's values as well as 2016's books accounting. And it's easy for us when it's shown like this, because we could do a straight comparison through and understand comparatively how the operations and the Walmart's or a company's operations are performing. So let's dive deep into the asset sides. Now this is a snapshot view directly taken from the balance sheet, and in fact directly taken from the annual report. And this is very useful because annual reports delves deep into each of the category and explains why the value appears so, what is done in terms of accounting, and why the consolidated financial statements are reflecting the values it is. Now here it's Walmart's assets denoted in terms of amounts in millions of dollars as of January 31, 2017. So the financial year in US ends in December, whereas for some countries like India it is till March the financial year end, right? So the annual reports typically tend to be consolidated around the fiscal year. And here the assets totally are into two parts. They have usually the current assets and the long-term assets, or so-called non-current assets. Current assets, as the name says, typically has 4 to 5 components within that as part of the accounting standards, and the non-current assets has 3 to 4 or 5 components within that. and put together measures the total assets in terms of in this case millions of dollars, sometimes billions. It depends, the denominations are determined by the company CFOs and the CFO unit. So we will look into the short term assets, which are nothing but the current assets, and the long term assets, which are nothing but the non current asset. As the name indicates, it's very self explanatory. So here in current assets, you could see that total current assets for Walmart is $57.6 billion in 2017, which has decreased from $60.2 billion in 2016. And total the non-current assets, which is put together of the remaining sum, it has actually stayed in course, and the total assets has decreased by marginally $500 million. So net this gives a good comparative view, and we will understand now what each of these terms in assets side means. So the first one on the asset side is the cash and cash equivalents. So current assets has main components like cash and cash equivalent. Then they have receivables, account receivables, which is netted off suspected receivables, and then they have inventories, which are measured in typical measurements like the LIFO method, last in first out method, or first in first out methods. But there are different ways of accounting standards followed for registering and recording inventories, and then there are prepaid expenses, which are typically might or might not be seen in every balance sheet, but generally cash, receivables and inventories are present, are shown or accounted as part of the current assets. So cash and cash equivalents, let's understand what that means. The company considers investments with a maturity when purchased of 3 months or less to be cash equivalents. So that is in the case of Walmart. Typically any company that has investments which are very short term in terms of the maturity levels, which can be available easily for sale or easily for redemption or easily for usage, are classified as short term or cash equivalents. So in Walmart's case, all credit card transactions, right? Typically it's all point of sale, credit card, debit card and electronic e-transfers, which are done as part of transactions at point of sale or even online, that processes within 7 days are classified as cash and cash equivalents. The amounts due from banks for these transactions are classified as cash and cash equivalents. So typically bank settlement takes, after we do the debit credit transactions or even checks or any other electronic means, takes anywhere between 7 to 15 working days to settle. So they are classified as cash and cash equivalents. The amounts due from banks are noted, and then the cash is generally kept by companies to meet the near-term liquidity or immediate need for the money to run the day-to-day operations, and including the working capital. Now, on a side note, each of the assets that are considered by different firms are specific or idiosyncratic classifications. For example, in terms of how Adobe defines cash section, Adobe usually classify all of their cash equivalents and short-term investments as available for sale. In general, these investments are free of trading restrictions. So they carry these investments at fair value based on quoted market price or mark to market information, and typically cash equivalents are money market mutual funds, things like time deposits, short term fixed securities, etc. In this case, Walmart had cash and cash equivalents of $6.8 billion in 2017, and it has come down, right? So if you see, that was $8.7 billion of cash and cash equivalents. So account receivables alias trade receivables, are amounts billed by the business to its customers when the business delivers goods or services to them in the course of the business. So typically these are billings which are documented on formal invoices, which are consolidated view in terms of receivables with along with aging report. Now receivables are stated at their carrying values net of a reserve for doubtful accounts. Now what are these doubtful or dubious accounts? Are typically, when the sales are made and the customers are doubtful to pay back for the goods that was sold to them. Sometimes it ages a lot and the customers might not be in a position to honor the invoices, and it could end up being a default. So typically based on experiences by the firms and companies, they mark certain accounts as dubious or doubtful, which will not be received. So those are netted off, basically removed or netted off from the account receivables. In this case, specific for Walmart, receivables consist primarily of amounts due from the listed items here, right, which is usually they sell goods and services for cash at the counter, register, and point of sale. Walmart does not have, I mean, it's immediate payment, which is great about the retail business. They receive the amount immediately or within few working days based on the bank settlement timelines. Now what are receivables in Walmart's case in that case? Now let's see. So examples are like, or the scenarios here are like the insurance companies resulting from pharmacy sales. So Walmart has a significant portion of the revenue coming from pharmacy sales, and pharmacy typically has a process where the settlement goes through insurance companies, and the insurance companies would validate, qualify, and approve, and by the time the settlement happens, it's typically in months. So that is one portion of the account receivables here in Walmart's case. And banks for customer credit, debit cards, electronic bank transfers, that takes excess of anywhere between 7 to 15 days to process. So that is not a significant operating cycle. I mean, it's quite quicker in terms of settlement. Consumer financing programs in certain international operations also pertains to the account receivables. And then there are suppliers for marketing or incentive programs. So this is a very rare scenario where Walmart's rewards and the suppliers pay back in terms of whether there are incentive or programs. They would be paying Walmart in due to the incentive programs they're tied up with, and that might be due for or due through a receivable, through an invoice receivable. And real estate transactions, obviously the settlement is a longer cycle. They have a lot of owned assets, and there could also be payments due from the lease payback and things like that. Now delay or delinquencies of account receivables usually cause great ordeal for the companies who find it cash constrained to run the business operations. If you take a scenario like Walmart's, it is not that impactful because it's a significantly large organization and enterprise with so much of cash that can be plowed in immediately as a need arise. Whereas imagine where there are small firms, small and medium type businesses where they are in desperate need for cash deployment, and any delay or delinquencies of the account receivables will significantly impact their working capital cycle and operational cycle. And this is pertaining to especially firms where they don't have significant pricing power or negotiating terms with customers, right? In the starting stage, they might have to wait for the payments and account receivables, and collection process is a painful process. So typically when the receivables are not obtained, they are moved towards the collection agencies, and collection firms gets involved in ensuring that the customers make the payment and the receivables are procured. Now typically here the increased account receivable collection times can increase the cash conversion cycle, obviously, of these firms. So it's very important that companies and businesses engage in actively seeking out and gathering all the accounts which are due, and also their focus should be to continuously improve the cash conversion cycle by following up rigorously and negotiating properly with the customers, ensuring the proper contractual and covenants are present well ahead before they make the sales of the goods or does the services. In this balance sheet, Walmart had around $5.8 billion of account receivables for the year 2017, and that covers the receivables part. So if you take the total current assets, which is $58 billion, the receivables and receivables forms a very small portion, like around 10% here. 10% of the total current assets. So some firms might be having even larger, where it is not the cash is not settled at the point of sale. For retail industries, the receivables are fairly less. Even Walmart's case, it's still 10% is high that way. Inventories are the store of three main things that we need to know. They comprise the finished goods, which are completed products, raw materials, which are in knife stage, which is yet to be processed and to manufacturing, and work in progress, which are in the process of production. It is still in the production, it's not out of the production to the shelves. Now the inventories are classified as current asset, as we discussed earlier. Inventories are managed by the companies to maintain sufficient level to meet the sales demand. Inventory management in itself is a big science, and there are enough books and enough courses available to study how the inventory management is done by the firms. It's a very difficult subject, and it's very difficult to run real time in businesses, and inventories are managed at maintaining at an optimum or sufficient level, and continuously working towards planning and forecasting based on the surge in demand that is anticipated, or the drop in demand that could happen due to cyclical issues. Now, demand pipeline can be forecasted based on experience over the years. You could see that in US, the Black Friday sales is we can anticipate a huge demand, so firms really plan their inventory accordingly and to meet the demand pipeline. And also, inventory management has, in addition to the forecasting, planning and things, there are different stages, right? I mean, from the flow of the goods from raw materials to the manufacturing machines and production lines, and then how much to plan for just-in-time delivery for meeting the pipeline and moving into the shelves are all part of the inventory management. A typical example of inventory management is discussed here in Walmart's case. In Walmart's case, the company values the inventories at the lower of cost or market as determined primarily by the retail inventory method of accounting. Now, there are two parts to this. There is one called last in first out method for accounting inventories, and there is a first in first out method for registering the records and books. Now, Walmart follows two types, both the types actually, one on the last in first out for registering and recording the inventories in US segments, and for their international segments they follow the first in first out method. This itself has a lot of details that can be learned in later stages of inventory management, which we'll take as a different section, but at this stage it just understanding is like it just indicates the last in first out is based on its evaluation or its arrival of value that has to be recorded for accounting, how it's done, whether it is on the latest market price or the original cost they brought out, and it's also determined and driven by the flow of the goods to the inventory from a first in and which is sold first out. Now, inventory is a very important aspect in the retail industry per se, because they carry high levels of inventory to run the operations, and it can be, we can track the changes in the levels of inventory from the cash flow statement, as indicated below. So here's a snapshot view of the cash flow statement. You could see that the total cash that is getting coming in as an inflow and what is outflow, and that might be usually in proportion to all the assets and liabilities. In this case, we spoke about the receivables, inventories, and account payables, and all three you could see what was the value in the fiscal year ended Jan 31, 2017, in 2016, and in 2015. Now you could see the inventory levels, in a positive 1 billion, approximately $1 billion in 2017, and whereas it's a negative $703 million in 2016, and another $1.2 billion negative in 2015. So as I have put across arrow, an increase in company's inventory indicates that the company has purchased more goods than it has sold. Now, since a purchase of additional inventory requires a use of cash, it means there was an additional outflow of cash, and that is usually shown as a negative value on the company's balance sheet. Prepaid expenses, as the name says, they are usually short-term or current assets, because the prepaid amount will be used up in the near term within a year of the balance sheet date. Now, examples for these are like prepaid examples, like insurance paid for a year upfront, rental allowances paid in bulk for a year, and that gets equally distributed and capitalized in the assets as near-term assets. And also this forms part of the current assets. So these are some of the scenarios where prepaid expenses get recorded in accounting. So it's really, if the company's operating cycle is longer than 1 year, still the definition allows for assets turning into cash used up or consumed during the operating cycle to be reported as current asset. So that, I hope it's clear. So now finally coming to total current assets, which is calculated as the summation of all what we saw above, like cash and cash equivalents plus the trade receivables plus the inventories plus the prepaid expenses. That put together gives the total current asset, which we saw it to be around $58 billion in Walmart's case. Coming to the long-term asset side of the balance sheet, these are usually fixed assets, primarily comprised of fixed assets and property, plant and equipment, as it's stated in US accounting terms under GAAP, which is generally accepted accounting principles. And property, plant and equipment, PPE, for the ease of use, are fixed asset bought by the company, and as part of the capex it is bought out, and they set up the firm to increase the capacity of production. Now, they typically include the purchase of land where the firm builds the factory or stores, buildings as the establishments of the firms, warehouses where they store all the inventories, especially in the case of retailing, and so properties are typically the establishments of the firms, the land where the buildings are constructed or the stores are constructed to do the business. And plants are typically machineries which are required to manufacture the merchandise or goods for selling. They are the production house, as we can call it, where all the machines are put together to manufacture the goods. In Walmart's case, the property and equipments are stated at cost because they follow still the accounting principles based on GAAP, and the gains or losses on dispositions are recognized as earned or incurred. Now, costs of major improvements are capitalized by Walmart, while costs of normal repairs and small scale improvements in their factories and warehouses are accounted as maintenance expenses as part of the income statement. Now, Whether to capitalize or make it as an income expense on the income statement is a decision usually taken by the firms in their discretion, and at the same time meeting the norms and standards of the accounting principles within the what you may. And so in this case, Walmart has taken a decision to expense out the near term on the income sheet. Then what we don't see here in Walmart's case is something called research and development as part of the long-term assets, and generally research and development does not gets capitalized in based on the GAAP principles or even IFRS to a great extent, whereas IFRS reporting standards allow certain portion of the development cost to be capitalized, which is a good thing, because R&D just getting expense income in income statements are really causing can really cause a lot of near-term movements to the bottom line, and can be really detrimental for the near-term returns for shareholders also. In this case, we see that there's a snapshot view. Land land is valued at around $25 billion in 2017, which has gone down from 2016 value. Buildings and improvements are estimated useful lives are reported as 3 to 40 years, which is quite true, and reflects a real picture. And the range is way too high, right? 33 to 40 years. And so here buildings and improvements are valued at $98.5 billion. And so these are stated at cost. So the real value, what market is perceiving, or the value of these assets at market value might be significantly higher, because we are talking about land and buildings of Walmart which were procured or invested, and initial capex made maybe 30-40 years back, but the value of these lands and properties might be significantly higher at mark to market at this juncture. That's something we need to always take care when we assess the balance sheet and assess the asset value. So because asset value is very important, key ingredient to value investing, arriving at what the firm is really worth, and asset value forms a major decision maker in arriving at valuations. So we need to be cautious about the valuations that is done by the firms in the balance sheet. And it could be the other way also, it could be marked at cost. If it's bought at say 2007 at the peak of the real estate cycle, it might be still significantly lower if it is marked to market, right? So those are important factors we need to keep in mind when we assess the asset value. Then they also indicated here the transportation equipments like the trucks and all other movable assets between 3 to 15 years, and that's the usual lives, and the usual lives are a driver to do the depreciation in the balance sheet. So that is something why Walmart is indicating the useful lives, and it's very useful for us to evaluate the depreciation factors also, which is an important factor again to do the valuation. Asset value, we have to consider depreciation also as an important factor. Property and equipment, so to put together, is around $180 billion, and accumulated depreciation, it's around $70 billion. So that is netted off. So the property and equipment price net of depreciation is valued at $107 billion as against $110 billion in 2016. Now Walmart also has, many of the retail stores, especially in US, has something called as capital leases. Walmart has lots of property under lease assets that are capitalized, and lease is typically a contract outlining the terms under which the owner of the property agrees to rent the property to another party. Now it guarantees the lessee, also known as a tenant who is consuming or using the property. It guarantees the leaser, the property owner or landlord, regular payments from the tenant to the owner over a specified stipulated period of time. It could be number of months or years. Now, the capitalized leasing method is an accounting approach which posts the company's lease obligation as an asset on the balance sheet, and you could see that recorded in the Walmart's balance sheet too. Now, coming to the last part of the long-term assets in Walmart's balance sheet is goodwill or intangibles. So, goodwill is a very subjective term. It can really influence asset valuation higher or lower based on it's a perceptive value. It is not really anything derived or determined based on real numbers. So, goodwill here represents the excess of the purchase price over the fair value of the net assets acquired in the business combinations and is allocated to the appropriate reporting unit when acquired. So, whenever there is an acquisition, whatever is the fair value of the net asset and any price over that for which the company acquires, that gets registered as goodwill. So, the delta of the fair price and what price the company acquired, that delta is registered as goodwill. Now, in Walmart's case, it had a couple of acquisitions. It had acquisition of Jet.com in 2016, I believe, and then there is a Flipkart, an India-based e-commerce firm they acquired in 2018, I think. And so this we are talking about 2017 balance sheet. So they are showing the goodwill of $1.77 billion factored in for Jet.com and other smaller scale acquisitions made in the domestic side. And this is something which we need to take with a pinch of salt, and definite lived intangible assets are considered long lived assets and are amortized on a straight line basis of the periods that expected economic benefits will be provided. Now, goodwill is evaluated for impairment as well, using either a qualitative or quantitative approach, which is subjective again for each of the company's reporting units. So it is a value which we need to really factor in. And when we do the value investing, when we do the valuation of the firms, we typically negate the goodwill out of the assets because it really does not reflect the true value of the firm. And also, goodwill could be an important factor in in many of the firms which have strong brands. Now, that is an area where we need to really consider the brand value when we do the valuation, which we will discuss later and when we study the valuation. But keep in mind that goodwill can be considered or not considered based on the type of business they have. In Walmart's case, goodwill carries a lot of value because we know Walmart is a big brand, and so goodwill will have to be considered as part of the valuation when we consider the assets. We have arrived at the final slide, which is the total assets calculation, which is a summation of total current assets and total long-term or fixed assets. And here $57.6 billion is what Walmart has in terms of current assets, and $141 billion is what they have in terms of long-term assets. Put together, Walmart has around $199 billion of total assets, and we can deduce from the balance sheet that Walmart is heavy on fixed asset. It's a capital intensive firm. Obviously, it's got a lot of capex done, and it is almost significant, right? We can see 2/3 of the assets is into long-term assets, and it's obvious in case of large retailers which are spread across the globe. So that brings to the end of the balance sheet analysis for the asset side of the firm, and next we will get into the liability side and equity side. Hope this was quite informative in terms of understanding the balance sheet on the asset side.